How do you know if you are truly ready to buy a home? Like, how do you know? Have you ever asked yourself, like, am I really ready for this responsibility? Am I really ready to take on a mortgage? Like, how do people know when they are truly ready to become homeowners? Like, when you see 25-year-olds buy a home, like, how did they know? 35, 45, 55, even 65 years old. How do those people know that the time was right, that it was their time, that everything would line up and work out so that they could get keys in hands? How do you know if you are truly ready to buy a home? Well, I'm glad you clicked on this video because I am going to give you some tips on readiness so that you'll know for sure if this is what you should be doing at this time in your life. My name is Tranett, and you just clicked on Car Conversations with a Realtor. I just pull over sometimes and make videos to share with you, to build you up, to encourage you, to put you on game as it relates to buying a home so that you can be prepared. Okay, so let's talk about this, friend. How do people know when their time has come to go and sign those documents and get a deed in their name, a mortgage in their name? How do people know? How can you know? Well, the first thing is, it's going to be a mental mind shift. It's just like something snaps in your mind. Like, you just wake up one day and you've had it. I mean, literally, you're just like, you know what? I'm done with this. I'm done renting. I'm tired of these kids running above my head in this apartment. I am tired of not having my own parking space. When I come home from a long, hard day's work, I have to circle this lot so that I can find a space close to my building. I am tired of having to go up flights of stairs when I have groceries and then come back, go back, come back, go back, taking long trips to the parking lot just to get back to your door with all those groceries. You just know when you are mentally ready. You are mentally tired of renting. You are looking at everyone else that are closing on homes and you're like, they're no better than me. I have a good job just like them. I pay my bills on time like they have. Like, what is it that they have that I don't have as to why they have a home and I am still renting? That is the mental shift. When you make it to that point, that's a clue. That's a sign, friend, that you are ready. You are moving into a place of being fed up and being tired of doing what you're doing. You're moving to a place where you're sick of signing leases, and every time you turn around, there's a rental increase, and you're just like, how much more? Like, I'm not going to take another rental increase. I'm not going to go through another leasing manager. You get tired of them, the turnover in the front office. You can't talk to people. You can't get the landlord to or the maintenance person to do timely repairs. You just have this shift in your mind that says enough is enough, and I am willing to do whatever it takes to make a change. So that's your first indication that you're ready. It's a mental mindset shift from wanting to just rent and being content with that to now I want more. Now I want my own. I want a home for myself. I want a home for my children to come to on the holidays. I want a home for my children's children so that I can leave a legacy, so that I can leave something behind as the family home. That's the mindset shift. If you are a younger person and you're working hard in your career, you're making great money, and you're renting one of these expensive luxury apartments, which are designed to make you think that you're living in a home, and they have all of these great amenities that you probably don't go to, a huge swimming pool that's like resort-like, a movie theater, little bar area. These apartments are enticing us with all of these amenities, knowing that the typical renter is not even going to partake, but it is there if you want to. But that's to help justify paying $1,500 a month or $2,000 a month or even greater. So that mindset shift lets you know. You just start to become aware of how you're spending your money and how much more renting is costing. And then when you think about it, you're just like, shoot, I could be buying a house for the amount that I'm paying in rent. Mindset shift. Once you get to that point, that's your first clue of readiness. And then you start researching, what are the processes? What are the next steps that I need to take in the home buying process? It leads you to check your credit. It leads you to start talking to realtors, to start going to open houses, to maybe even fill out a loan application, because you are now ready for the next steps. So second step to know, like these people who have purchased homes, how they knew they had financial stability. That's number two. After you're mentally ready, then your finances have to align. Do you have stable income? Meaning, have you been on your job at least 2 years? Now, that's not a requirement, but it's nice if you have stable employment with the same employer for 2 years or greater. That's very favorable. You have a steady paycheck that's coming in every 2 weeks. You know how much you get paid. You've been there for 2+ years. That's stable income. Also, under financial stability and readiness, you need to have the ability to save money. Do you have a habit of putting something back for a rainy day? Do you have a savings account? Do you have an emergency fund? Which, by the way, I really encourage you, if you don't, to start with an emergency fund, at least $1,500. Just put that money to the side and try your best not to touch it. And if you have a true emergency, a tire blowout, the washing machine goes out, just something, a true emergency, you can dip into your emergency fund instead of reaching for a Visa or MasterCard or Discover, okay? They are not our friends. No matter what they try to tell us, Visa, MasterCard, and Discover, they are not our friends. And I'm talking to myself as well, okay? But having that emergency fund, you do need some money set aside for your home purchase. Now, many of you will be blessed with the opportunity to get down payment assistance on those first-time homebuyer programs. Or if you're not a first-time buyer, even the second-time homebuyer programs. Some of those programs work for any type of buyer. So, although your down payment and closing costs may be covered under a grant or down payment assistance program, you still need some liquid money set aside. Most of those programs do require a $500 buy-in out of pocket from the buyer to even get that down payment assistance program. So that's $500 right there, hypothetically. Then you're going to need to have a home inspection. Those you have to pay out of pocket. You cannot roll that fee into any of the closing costs. That is a true out-of-pocket fee. Now, home inspections are optional, but I highly recommend that you get a home inspection because it gives you peace of mind, and you need to know the condition of the home before you close on it, okay? But we'll talk about inspections in another video. And then also, you may need money set aside for some of your closing costs or to pay for your appraisal. Some appraisals are included in the closing cost amount, but some lenders require the buyer to pay for the appraisal. And the appraisal is performed by an appraiser that comes out, looks at the house, and tells you the true value of the house. That's a non-negotiable fee. All homes that have a mortgage must have an appraisal done, and you will want that anyway because you want to know the true value of the home. You don't want to overpay for it, and the lender does not want to overlend for it. So right there, that's about $1,500 out of pocket that you need to have saved for your home purchase. But that's another indicator that you're ready. If you have the ability to save money and you have some money set aside, then that's an indication that you are responsible and you are ready to move forward. That money can be for a rainy day fund. That money can be for repairs in the future that may come up. And it's just good to know that you have the ability to save some money. And then also, a good way to know that you are ready to buy a home is that you have taken good care of your credit. Now, nowadays, you only really need a 640 credit score to unlock the home buyer programs. If you have a 640, which is very doable, friend, that's very average credit, then you are in good standing. That means you are well on your way to being ready to become a homeowner. So let's just recap. You need to have steady income. Okay, you need to have a good, steady employment history. You need to have some savings. I'm not saying how much because I don't know how much. Sometimes people think you need 20% down. That's not true. And then the standard is 3.5% down of the purchase price. But if you get a down payment assistance program, then that 3.5% is taken care of. And let me just break that down really quick for simplicity's sake. If the home that you're purchasing is $100,000 and your down payment with FHA is 3.5%, then the down payment amount is $3,500. That's how much you will be responsible for bringing in out of pocket if you were paying your own down payment. So that's just an example of how the 3.5% FHA down payments work. It's 3.5% of the purchase price. So in this example, it would be $3,500. Okay, so you got money set aside, and then you have taken care of your credit and your scores are at least a 640 or better. Of course, the higher the score, the better opportunities, the better loan products you unlock with the lender. If you have 700 plus, that's a better opportunity. If you have 750 or 800, then you are really in the top tier of credit score buyers, and then you should be able to get the best rates that are available. So it pays to really work on your credit, but I'm not saying that you must shoot for a 700 before you apply, because that would still keep you in the renting cycle and spending more money on rent when you could actually be owning a home. So I'm not telling you that you must wait until you get a 700 or 800 credit score. A lot of buyers don't reach that until after they've purchased the home, because that's the largest debt that we can have on our credit report. So when you have a mortgage loan, then your score, after making several months of payments of owning the home, your score is going to shoot through the roof, because you have the large installment payment on your account. So you're going to get a 700-800 score eventually anyway. So that's just to encourage you. You don't have to have a 700, but just have a really good score that is at least a 640 and above. Okay, so the third thing, after mental readiness, after financial stability, you need to have debt management in control. This one is very, very important, friend. You must have your debts manageable. If you have maxed out credit cards, if you have huge car payments, if you have student loans all over the place, you are likely going to get denied. Even if you have really good income, and even if you have a really good credit score, your debt lets the bank know if you can take on any more debt. So if you are already maxed out on credit cards and other debts, and then you want to add a mortgage payment to that, the bank is going to see a red flag. They're going to consider you risky. They're going to think that you cannot handle any additional debt. That's why it's very important to make sure that you have all debt managed. Now, do you have to have all your debts paid off? Absolutely not. That is not what I'm saying. But if you have a credit card with a limit of $5,000 and you have $4,700 charged on the card, then that's a maxed out card. You need to bring that $4,700 balance down. Ideally, banks like to see your credit card limits be 30% or below. Okay? So again, if you had a $1,000 limit on a credit card, then no more than $300 at any given time should be charged on that card. That's 30% of the $1,000. Okay, so keep that in mind. You must bring down the debts. You got to bring in your student loans. If you have to consolidate, get a payment, start making a small payment, even if it's $25 a month that you're making. The banks have to see that a payment is being made on the credit cards. If you have really high car payments, keep in mind that those do get counted against you. I just had a potential buyer the other day. She makes really good money. She's in a frontline career field, and she has $1,200 worth of car payments. She has a car payment that's, one of them is $900 and it's financed for 84 months, and then she's a co-signer on another car loan for someone else, and it has killed her debt to income ratio. So the amount of home that she wanted to purchase, which she deserves because she makes good money, she's not able to because her debt to income ratio has knocked out that amount that she wanted. She wanted $250,000, but now she's down to $180,000. And if she needs down payment assistance, then she's only looking at $135,000. So you can see how your debts can really work against you. If you are in a position where you need a higher pre-approval amount and you're not happy with what the bank has given you as the amount of approval, then the fastest thing you can do to increase that approval amount from your lender is to pay down the debt. You've got to get those debts in check because they will really hurt you. You cannot have any missed payments, late payments. One late payment alone can unravel all of your hard work. So make sure you're paying attention to your due dates and that you are making the payments on your debt. Okay, so we have to just make sure that we have our debts lined up. And how they calculate that is that they're going to take all of your debts. This is how they calculate your debt to income ratio. They add up all of your debts. So if you have a car payment, if you have a student loan payment, and let's say you have 2 credit cards, they're going to add up all of those, the minimum payments, not the full amount of what you owe. They're only looking at the minimum payment. So if you have a car payment that's $445 per month, but you owe $27,000 on the car, the bank is not looking at the $27,000. They're only looking at the $445 payment. So you can breathe. You can rest a little bit, okay? So it's not that detrimental. They're not looking at the total amount you owe. They're only calculating the minimum monthly payments. If you have a Visa card that has a $5,000, you owe $5,000 on it, and the payment is $125 per month, then they are only looking at the $125 payment. They're going to add up those minimum credit card payments, minimum student loan payments, minimum installment loan payments, and car payments. They're going to add that up. That's going to give them the amount of your debt. Then they divide that by your gross monthly income. They do not take in account for car insurance, cell phones, health insurance. None of those things are counted or included in your debt to income ratio. Only revolving debt that you pay on every single month will be counted against you. So again, a person who has a really high salary, let's say you're making 6 figures, you make over 100,000, but you are maxed out on everything and you have expensive cars that you drive, you can very well not be pre-approved because you have too much consumer debt. Okay, so this is how you'll also know if you're ready, is if your debts are manageable. And so the last thing that I want us to consider when we are thinking about being ready is our long-term commitment. Like, are you ready to make a long-term commitment to buy a home? It's a 30-year commitment, but although you are not paying the whole loan off for 30 years, you may not pay the loan off for 30 years, but you are making the commitment to say you want to do something different. You are saying, I am committed enough to become a homeowner. I am committed enough to make this commitment to buy a home. And let me just say this, friend, if you are renting an apartment or you're renting a rental home from somebody and you've been renting for 3 years or 5 years or 7 years, 10 years, 20 years. I've had clients that have rented one apartment for 20 years. If you are renting long term, you don't have a problem or an issue committing to a mortgage. You don't have a commitment issue. You just need to shift the rent that you're paying to homeownership so that you get the credit for the amount of money that you're spending every month where you reside. So let's keep that in mind. Don't be afraid of the 30-year commitment to sign a loan. You may never pay that off. You may sell that house and buy another house, and then sell that house and buy another house. And you may never pay off a full 30-year loan. And that's okay, because you don't have to. Just know that you're making a commitment. And then lastly, on your readiness, you need to keep in mind that there is no longer a maintenance person. Repairs are all on you. Okay, so if you're okay with maintaining your home, then you're ready. Don't be afraid of maintenance. One of the major reasons why you need to have a home inspection is because you will know the true condition of the house before you purchase it. So you're not going into this blindly, not knowing what you're buying. You're not buying a lemon like if you were buying a car and you didn't test it out, and then once you got it off the lot, it stopped working. You are doing your due diligence to buy a great home. So from there, once you take ownership, you just need to maintain it. And it's just like owning a car. Don't be afraid of home maintenance. Don't even be afraid of buying an older home. You just have to maintain it. Like we have to maintain our bodies. We have to maintain our cars. It's like you don't just ride the bus when you can drive a car because you're afraid of the maintenance, right? Yeah, you may have a blowout. Yes, you have to get oil changed. Yes, you have to get the tires rotated. You may have to get a tune-up, every so often. But that little bit of maintenance doesn't keep you from owning a home, does it? Of course not. So don't be afraid of maintenance with the house. It's just normal wear and tear, just like everything else that we own in life. You just have to maintain it. So don't be afraid of it. But if you're not afraid of maintenance, then you're likely ready. And if you really mesh up, you line up with all of these items, your mental shift is there. Your financial stability is there. Your debts are manageable. You're not afraid of a long-term commitment, and you're not lazy. And you are okay with doing maintenance to your home, to your investment, then friend, you are ready. to buy a home. And I hope that this has helped you to see and to do some measuring yourself to know if you are truly ready, because everyone is ready at different stages in life. Not everybody, there's not a time frame, there's not a time clock that says you should be a homeowner by now. It is all based on that individual's readiness. And if you are ready, friend, then pull the trigger. Allow 2025 to be the year that you shift the mindset, that you shift the wealth from the landlord to yourself. You can do this. I believe in you, and I know that you can make it happen. Now, if you've been watching my videos, or if you found this video helpful, I need for you to subscribe. My mission is to help home buyers, soon to be home buyers, to educate you, to put you up on game, to teach you more than what you can just find online, to give you real examples of what to expect should you buy a home in the next 12 months. That's my whole goal. And when I find YouTube channels that speak into my life and that help me reach my goal and push me into my destiny, then I subscribe. It's free. So I'm telling you, I'm asking you to please do the same thing. If I can help you on your home buying journey, then please subscribe. I love to be with you until you come back and report to me with a photo of you in front of your home with a soul sign saying, I did it, I made it happen. I long to hear that from you. That's my whole goal for this channel. So I appreciate you for watching. I look forward to seeing you in the upcoming videos, and you take care. Remember, you are ready if you match up and measure up to all the things that we talked about in this video. Thank you. Bye-bye.